Today we are going to discuss part of credit risk management what we left over the other day, and also I have shared operational risk management slides for us to continue our subject matter. However, I can see only about 19 people have joined yet. Until a little more crowd stepping into this program, we'll have a look back what we have done the last 3 sessions, and I also said I'm going to do some homework for you, because elaborately to explain the corporate credit risk analysis, I said that I will take some examples from the local scene, and also today I have shared that with you. Also, I have shared one more slide on risk of a bank, again looking at the balance sheet of a bank, and also then I have shared a credit risk measurement slide. So 3 slides are there which we are going to explain. To look back, originally we discussed what is risk, and then we also discussed we gave a definition what is risk management. Then we went on to looked at the types of risk financial institutions face, and on top of that list we said financial risk. Under financial risk I described there are 3 other categories. We looked at credit, then we said market and liquidity risk also a part of financial risk. Then we also discussed about operational risk, strategic risk, regulatory risk, and on the side we also looked at other risks which financial institutions face are legal, reputational, and technological. So on that we went to integrated risk management. In that we looked at the direction given by Central Bank of Sri Lanka, direction number 7 of 2011, which I shared with you. And on that we said all the banks need to have a risk management framework. A framework should consist of policies, procedure, and also the structure. So we looked at the ideal structure for a bank, which we call it 3 lines of defense. Then we also looked at various policies pertinent to risk management, which the risk management team will have to develop and get board approval on them. Then we also looked at certain procedures. The procedure is mainly considered as identification, measurement, response, monitoring, control, and reporting. So on that basis we moved on to our first type of risk, and which is the largest risk based on the balance sheet of a bank, which we called it credit risk. So credit risk I again categorized into 2, which we said credit risk mainly is the default by customers who borrowed money from the bank. So credit risk we divide into 2 areas. We said 2 categories: counterparty risk or the borrower risk, and also concentration risk. So far we have discussed with you the counterparty risk in detail. In that we came to corporate credit. In that what we said was, in the corporate credit we identified analysis based on a system called 4-step model. In the 4-step model, first we said the first step is to look for the purpose, and the purpose I explained, the purpose could vary from working capital requirement to asset financing or settlement of liabilities. And we went to type of paybacks. Payback generally it's cash flow profits, but certain institutions can adapt any other method of payback by asset realization, so on. Then we came to risks, and risks are we categorize. That's our main subject. We said even like we face financial risk, corporates also face financial risk. If they fail to manage financial risks, they'll be in trouble. So we looked at financial risk by way of analysis of ratios. So today on these slides, which is on screen, what I have done was I have taken 4 leading corporates in Sri Lanka. 2 I have selected from the same category of business. The first one is Dialog, which also in the telecommunication industry, and SLT, Sri Lanka Telecommunication, Sri Lanka Telecom, also in the telecommunication business. So we'll do a comparison of how we analyze their figures. Then I also took 2 other companies. They are giants in themselves. One is a Cargill's. It's a trading company which has a huge supermarket chain. So the other one is Ceylon Biscuits Limited, which is one of the manufacturers of leading biscuit manufacturer in Sri Lanka. So I have taken 2 from telecom industry and 1 from the trading, 1 from the manufacturing. So we'll see based on their business models how this our financial analysis, the ratios what we analyzed earlier, will get differs, so that you can have a good idea of risk pertaining to corporate. So to do that, to do various ratios, I picked up some figures. I went to their websites, went to their annual reports, and based on the 2019 annual reports, I picked up these figures. And Dialog, SLT, Cargill's are large companies, so I have stated those figures in billions for easy calculation. Ceylon biscuit manufacturers, their overall net profit was only 170 million, so it will go, if I put billions there, it will go into 0.17, so which is not correct. So I picked their figures in millions. So you can see the 4 companies, Dialog, all the figures are in billions, SLT again in billions, Cargill's in billions, Ceylon Biscuits Limited, it's on millions. So you can see the first line is called sales. You can see Dialog has done, their revenue is about 116 billion in 2019, compared to the same industry, another giant, SLT, which they have done only 85 billion. And Cargill's trading company, which has done 94 billion, and CBL has done 1,915, so it's 1.915 billions sales. So this is the top line, because which is, in order to calculate various ratios, we need sales. Then we also looked at their current assets. I told you these companies' current assets mainly consist of any cash holding, debtors, and the stocks. So you can see Dialog is having 30 current assets, SLT 46, Cargill's 21, and 981 million by CBL. Current liabilities also needed to do various ratio calculations, especially current assets and current liabilities are required to calculate the liquidity. Therefore, I took that figure also. Current liabilities, Dialog 60 billion, SLT 57 billion, Cargill's 34 billion, and 278 million by CBL. Long-term liabilities also take part of another balance sheet item on the liability side. You can see 42, 74, 6, and 162 million. So total assets by these companies also is inclusive of their fixed assets. I have not stated the fixed assets, but if you deduct current assets, the balance is fixed assets. So 176 total assets of Dialog, 209 on the SLT, Cargill's 68 billion, 1.248 billion by CBL. This is how their total assets stand and the liabilities. Then the other component on the liability is equity. It's the shareholders' money. Dialog 74, SLT 78, Cargill's 18, and CBL 808 billion. So we'll go into their net profits. Is you can see Dialog has made 10 billion, SLT 6 billion, Cargill's 2 billion, and 170 million by CBL. This is their net profit figure during their financial year 2019. And first, in their corporate financial analysis, I went to liquidity. Liquidity, you remember, I show the slides. Current assets divided by current liabilities will work out to the current ratio. We also discuss quick ratio, but I have not taken that into here in order to maximize the space available on these slides. I only took the current ratio where liquidity is concerned, and you can see their current assets 0.30 and compared to current liabilities where Dialog is concerned, they have it's 0.5 versus 1. That means current assets is half the size of current liabilities. Now, if we go back to our standard bankers' acceptance on this liquidity ratio, we said 2:1. Now you can see Dialog has 0.5:1. Now Dialog is a company which is not, I would say it's a trading, they also sell, but it's a company in the telecom industry providing a service. And they don't need to hold much debtors, and their model is such that they like to charge a customer even prior to making their services available to them. That's why we have this prepaid card. So as a result, they don't have large debtors. They also don't keep current stocks. So as a result, their liabilities are 60 compared to current assets 30. So it's 0.5:1. So our norm of 2:1 doesn't apply to a company like Dialog because they are on a different business model, and that business model is to create a very low current assets because they believe their model will help them to eliminate debtors and stocks to the maximum and use that model to create more value to their stakeholder. That's why they are carrying with the 176 asset base, they have made 10 billion rupees. SLT is in the same business. They have 209 overall assets. Still, they have made 6 billion. You can see even SLT in the same line of business, so they also don't carry much, but they have postpaid packages. As a result, you can see their current assets are a little higher than current assets of Dialog. Having only done 85 billion in sales, they may have half the size of that is in debtors. The current, so 46 is very much higher compared to a sale of 80. So their main line of business is providing services, but on a postpaid basis. As a result, they have higher current assets. Still, you can see it's 57 to 46. So as a result, 0.8:1 is their current ratio. Now this current ratio is still lower than what the bankers accepted, which is 2:1. That is also because they are in the service-oriented industry. They don't have to carry large stocks. They don't have to carry large debtors. As a result, they manage their current ratios. Even assets are much lesser. So they can get these assets financed through the supplier's credit. So this model is high profit-making models. Compared to that, we move on to Cargill's, which is in the trading. This trading company has done a sales of 94 billion. Their current assets is also very low. You must be wondering, a trading company need to carry large stocks. But however, their debtors is minimum. Cargill's will sell either for cash or they will sell for cards against credit card. When you sell for credit card, the bills will be sent to the bank the following day and they will get their money. So it's maximum 1 day credit they get, next day they will get their money. So as a result, they don't carry much debtors. And generally Cargill also they also take suppliers credit to the maximum, and compared to current assets, they also have larger current liabilities because the suppliers are not being paid for some time. Maybe they will have 90 days credit from their suppliers. So as a result, even at a trading company, you can see their current ratio is 0.6:1, and this model has enabled them to make a lot of money. So especially if they want to enhance their branch network, they have a huge cash flows. As a result, they don't have to go to bank and borrow. So you can see their long-term liabilities is just 6 billion. They haven't taken long-term loans from banks. When you don't take long-term loans from the bank, their finance cost is lower. When their finance cost is low, their net profits are higher. So generally, the items which have been sold doesn't have a margin of more than 10%. But however, compared to the dialogue and SLT, their margins are very high. As a result, they make more money because it's a service what they provided, and they don't have cost of goods for sold. And whereas Cargill's, they'll have to buy goods from outside and resell it. So their margins are lower, yet they have made 2 billion profit. Compared to Cargill's, we move on to CBL. You can see their current ratio. Their debt liabilities are 278 against 981 of current assets. They sell for credit. They have to carry stocks. As a result, CBL, a manufacturing company, their cash conversion cycle is much longer than any of the three companies earlier what we discussed. As a result, they carry large current assets. Current assets mainly include debtors and stocks. So you can see it's 3.5 to 1. Generally, bank will be happy is 2:1. But here, because of the cycle take a longer period, and therefore it's 3.5 to 1. So bank may be concerned about their liquidity, and probably if bank is funding it, this is little higher than normal bank would like to have. Then we move on from liquidity to solvency. Now, solvency is about the stability of the institution, and we generally the stability is compared or measured by way of debt equity. How much contribution their shareholders has made against the borrowing. So you can see debt equities we generally calculate looked at the long-term debt against the equity. Now Dialog, they have borrowed 42 billion on a longer term compared to their shareholders have contributed or based on profits retained and now equities worth 74 billion. So generally we said 3:1 is a good ratio to lend. Now you can see solvency ratio of Dialog is 0.6:1. So it's very stable, and a company of this nature, uh, stability is at the highest level. Similarly, SLT you can see 0.9:1. That means they also have equity of 78 billion against 74 billion what they have borrowed. So almost contribution from shareholders are equal to the bank's borrowing. Still stable, 1:1. Like Cargill's you looked at, I told you their business model doesn't need to borrow long term. They have huge cash flows. So they have equity of 18 compared to long term 6. So it's once again 0.6:1 is their ratio. So on a company of this nature, we can even go up to 3:1, but Cargill is also a very stable company. 0.3:1 is their solvency ratio. Instead of 3, their solvency ratio is 0.3:1, which is very good risk-free lending you can do to a company of this nature. CBL, once again, a company, their equity is 808 billion and long-term borrowing only 162. So they haven't borrowed heavily on the long term. Their machines have been already funded. They may have taken working capital, and that will reflect in their current assets. So current assets, though it's high, their stability is very high. It's 0.2:1. This 0.2 even can go up to about 3:1 on a bank's acceptance level. So these all 4 companies where stability is concerned, they are at the highest level. That's why we call them blue chips, and you can see our financial riskiness be measured by way of liquidity. Other than CBL, all the others are very much far above required liquidity level. They carry high liquidity assets, so any liability can be paid. Since CBL has not borrowed long term, they have opted for short term. Still, stability is high because they have the leeway to borrow more money on a longer term. So now we move on to another measure we looked at in our corporate financial analysis or corporate risk analysis as financial risk is the profitability. Now I also mentioned that looking at the profitability, you said how profitable is your sales and how profitable is your company. Now our first ratio is we call net profit margin. Net profit margin is net profit divided by sales is the criteria we adapt in looking at the net profit margin percentage. So you divide 10 of Dialog's net profit by its total sale of 116 into 100 will give 8.6%. So they carry a 8.6% net profit margin compared to SLT of 7. And Cargill's, I said it's a trading company. Volumes are high, but though the turnover is high, their margins are low. So they carry 2.1. CBL, they manufacture their own goods, and they keep a bigger cut on the manufacturing. So they also in the trading, they have a trading arm. So they also have about 9% net profit margin. So this net profit margin will give an idea how profitable is their sale is. So if their net profit always is on the positive side, that means companies making money, enough cash flows to pay back bankers' loan. So this criteria of riskiness is understand when you look at 8.6% of their total sales come as profit. Therefore, Dialog is in a position to pay even large borrowing and they're risk-free. Similarly, SLT 7%. Cargills, their volumes are high, so they haven't borrowed any money. Long term also they have just borrowed, so their finance cost is less. They don't have to worry about NP margins anymore because they are not paying bankers any money, so they make a lower NP margin. Whereas CBL carry a high net profit margin and a stable company. Then we looked at how profitable is your company as a risk factor. If every rupee what you have invested in your total assets, now you can look at Dialog, they have their total asset is 176. Return on assets is you divide the net profit by the total assets. So what you have to do is net profit is 10 in Dialog divided by 176 into 100 will give you a figure of 5.68%. So they have a return on assets. Every rupee what they invest on their total assets, they make 5 cents. Similarly, SLT only make about 3 cents, 2.87. Cargills 3.5. You can see CBL make as much as 13 rupees cents, 0.6 cents per each rupee what they have developed deployed to make this company. So company also making profit. Not only their sales from margins are high, total assets what they have deployed to run this company also on a positive side. Similarly, you can see another measure called ROE, return on equity. We looked at return on equities, you divide the net profit by total equity. So where Dialog is concerned, equity is 74, so you 10 divided by 74 will give you 13.5. So Dialog shareholders will get return on equity of 13.5%, which is higher than the fixed deposit rate. So their investors will remain here with Dialog for a longer period, and they don't have a risk of losing investments. Anytime when they want to have a rights issue or additional share issue, they will hammer for this particular share, mainly because it gives a better return. Compared to that, SLT will give 7.7, Cargills will give 11.1, and company like CBL give 21%, which is very much higher. So if you are a shareholder here, your returns are much more higher than almost double the size of if you place your money in a fixed deposit in a bank. So this is another profitability ratio. If these things are positive, that means they create value to the stakeholders. Especially NP margin is positive, they will bring in cash flow profits. Those cash flow profits can be used to pay back the loans. As a result, risk is low. So companies which are making profit from sales return on assets are considered stable, and their solvency ratios are also on the stable, and liquidity is also more than the required what we have. So these companies are generally called blue chips, and investment on them or lending to them is kind of risk free. Then we also had another look at certain other ratios to look at how efficient these companies are. I took one ratio which we call asset turnover ratio. How quickly they can turn assets in a cycle. So assets turnover is you have sales, you divide by your total assets. So where Dialog is concerned, they have 116 billion sales and total asset of 176. Will give 66%. Will bring in sales. They can, to make every rupee sale, they will to invest 1 rupee on the assets, they can make 66 cents rather. Similarly, SLT make 41 cents on a rupee. Cargills make 162 on a rupee. That means their investments are low, yet they make more money because their model law is very good, because they don't have to borrow any money. They take large purchases on credit and sell on cash. As a result, their cash can be invested and therefore finance cost is low, and they make those stocks what they have taken, they can resell in their outlets many times before they settle the first purchase. So they are in a very much better position to have a higher value sales. So their total assets is 68, yet using 68 billion assets, they can sell to the value of 94 billion. So it is 162 times. Every rupee they invest on assets, they can sell for 162 rupees. So though the margins are low, you can see as a result margins are low, as a result they have only make 2 billion, but the volumes are very high. Similarly, CBL, also the asset turnover is 153%. So if you can make rupee per rupee, you are in a greater position because you can deploy 1 rupee on assets and have sales to the same value, you are better. But companies which are providing services, their assets are more or less fixed, like towers, buildings. So those investments will pay at the long term. So Dialog and SLT, though asset turnover is 66% and 41% still, they are giants in the industry. So with this, I hope you will understand the risk component of looking at the financial ratio. Financial ratios are generally looked at the financial analysis to evaluate customers' creditworthiness. Now, if these financial ratios are not up to the bank's standard, we also call it your counterparty is having financial risk. And if you're going to continue to have financial risk, there are chances that his credit, what he has borrowed money from you, will be in trouble, and there's a chance of default. So that's the very reason we look at these ratios to see the riskiness of your borrower, riskiness of your counterparty. So credit risk will come from the riskiness of your borrower. So evaluation is done to analyze that risk, identify that risk, and if the risk is high, you need to have risk mitigation techniques applied in funding them. So these slides, I hope, will give you a better understanding of what are the financial ratios and how do we do that, especially in the corporate sector. These financials have been audited. So if you look at a balance sheet or P&L account of a corporate client, which they publish as an annual report, have been audited by a reputed auditor, and financial institutions completely rely on the information given on those statements for their decision making. So that's the very reason we looked at corporate credit analysis, and we call it funding based on their balance sheet. Now, I also that day looked at we came across another area which I said I will do some more homework. If you could remember this, expected loss of a loan is equal to probability of default, exposure at default, and loss given default. ELs equals PD into EAD into LGD. Now I told you that it's difficult to understand when you say like that. So I said I will do a computation slide for you to understand. Even if I to write this on the board, it will take time. So I did a little bit of homework on credit risk measurement. So we will go into this because last time we stopped our session at this point. We looked at credit risk management side. We looked at the counterparty risk. Then we said other side of the coin is one is credit management, the other side coin is credit risk management. Under credit risk management, the first item is risk identification. Then we said we have to move on to risk measurement. Where risk measurement is a computation of a expected loss of a loan. Now, to explain this, I took 10 loans of equal value of 10 million each, and carrying a similar credit rating. You need to understand all the banks now adapt internal credit rating for their borrowing clients, especially borrowing clients. You need to have a credit rating. Now, banks have external credit rating from Fitch, ICRA, and various other companies. Some corporate customers also could go to these particular companies and get external rating. If not, banks have now decided that all of their customers who borrow money should have a credit rating, because that credit rating stands as a measure. Credit rating is based on various parameters of the client. You can take customers' financials and you can adapt various parameters. We'll say you take a customer, say he's from the service industry. If you go back to our earlier slide, one of the giant is Dialog. So now Dialog has a NPA ratio of almost 8%. So you take a similar customer and now we benchmark NPA ratio of a telecom customers on that trade. If you have another telecom customer coming to you, and when you looked at his financial, his NPA ratio is 6, then you benchmark against the best player who is Dialog, who is having 8. You give a lesser mark for this. So if that your customer comes and says, I have 8% to my audited accounts, that is Dialog, which is a prominent player in the telecom business. We benchmark against that and we give a lesser mark to that. Now say 8% is, you say 100 marks, another customer coming giving us 60, we'll give him something like 80 marks. So based on those parameters, you aggregate their total points. You will have in the internal credit rating module, you may have at least 60 to 100 parameters in evaluating the customer's creditworthiness. You can have various financial ratios, their liquidity is at what rate, their solvency is at what rate, their profitability is at what rate, how is the efficiency ratio, whether they are carrying large bad debts, whether they have a obsolete stock, all that you can take into consideration, making parameters for a customer when you are doing a rating for the client. Similarly, you can have qualitative factors also in your rating. You can say what is the market share of the product compared to similar players. So you can have management and ownership, their reputation, the director's reputation, also you can give marks. So when you add up all these, we'll say if you have got 90, total, if you take it up as 100 and if your customer has scored 90, 90 to 100, you can allocate a triple A company. That's how we generally do. So we'll say 80 to 90, you give double A, 70 to 80, you give 1A, and then 60 to 70, triple B, 50 to 60 to double B, and 40 to 50, you give single B, and below 40, you put them as C. And then these customers will not are expected to get facilities from the bank. They are, we call it non-investment customers or subprime clients. So in our computation or the measurement of credit risk, we need to take similar credit rating customers. Otherwise, their defaults cannot be identified. Now, in order to similar customers also, all will not default, but we took 10 customers who had on the same credit rating. We'll say their credit rating is triple B. So we consider these all 10 loans are triple B clients, and ideally the money also should have been taken for a similar duration. So these need statistical application in computer and to do compute, but to make you understand better, I took 10 loans of 10 million each. Customer is on one single similar credit rating, we'll say double B, and the results of these, 3 of them defaulted. You can see loan number 1 has defaulted 10% of the facility. Loan number 4 has defaulted 20, and loan number 9 has defaulted 30% of the. So we need to now in our measurement we need to measure the probability of default and the expected loss. Now in this calculation, probability is number of loans defaulted. So we can see probability is calculated, you take the average of this 20%, 30%, and 10%, 20%, and 30%. The average is, we call it loss given default. So we have a 20% average in this, and 30% of clients out of 10, 3 have defaulted. So 30% into average amount default is called probability of default. So you can see we have 10 loans, 3 have defaulted. So that means 30% of the loans have defaulted. And the loss suffered is 10%, 30% of 10 is, we'll say 3. And number 4, 20% is 2. And number 1 is 6. We total up to 6%. So 6 divided by 10 of a single loan is called 6%. So we looked at overall, we have 100, and if you take these percentages, 6. So LGD stand for 6%, and PD now LGD is 20%, the average, and PD stand for number of loans default 30% into LGD, which is 6%. So our equation expected loss equals PD into exposure at default, and to LGD will give us 12 million. This is how it has been calculated. Now we computed the probability of default at 6%. Exposure, we took the whole overall exposure, which is 10 into 10 is 100 here actually. You may have to take it, I think 10 is high. 10 million is the total value. 6 into 20% is, I think, 1.2 million you will lose. So you may need to change the figures here. PD is 6%. The LGD is instead of 1,000, it is 100. If you have a calculator, you can start calculating. I will also get it. 100 into 6% into 20% will give 1.2 million is your overall loss on these 3 loans when they default. So expected calculation, these generally you need to put this into a computer. Similar type of loans, similar credit rating loans in one category, and look for about 5 years their behavior, and that behavior will give you a probability of default, a rate. Then the percentage what you have lost also you may get from that history data, and then you calculate LGD, then overall exposure on those loans will give you expected loss. So this measurement need to be calculated, but it need at least 5 years data, and you need to have your internal credit rating validated for 5 years, and then you may have statistics to do this measurement. So at the moment, I think none of the banks in Sri Lanka has done 5 years internal rating validations. Some of the reputed banks, I think this year their main task is actually to go into finalization of their parameters validated. So from that time onwards, we need to go on for 5 years or at least 3 years to arrive at similar credit rating loans to a similar value for similar duration, and then based on the losses what they have suffered against on the when those statistics are available, they could compute the expected loss from a similar credit rated model. So now I'm moving to this is where we stopped that day. Then I said I will go home and do this some kind of a computation for you to understand, and that's what we have done. So now we are moving on to next item on credit risk management. Also, there is a now at this moment, if you looked at my earlier slides of credit process, we said when you business units, they do a paper called credit appraisal form, and this appraisal form is being transferred to credit risk management for their recommendation or approval. So what now we have got in this unit appraisal form, and on that we have done credit identification, that is similar to evaluation, and also we have done, if our ratings are foolproof, we may have done a measure. Based on that, now we have to give a response, that is to recommend or decline. But in this moment, credit risk management do various other evaluations. They will look at this particular appraisal is in line with the lending guidelines provided by them, because I told you under credit risk, when you do integrated risk management, we need to give a board 3 documents. One is credit procedure manual, credit risk management manual or policy. Then we also need to give lending guidelines. So when these things have been put for the board, and if board has been approved, those things we will go into the business line. So when they do appraisal form, they must see the appraisal form is in line with the guidelines already provided to them, which has been approved by the board of directors. So we looked at the risk point of view, whether this appraisal is according to the lending guidelines. CSPM is credit standard policy manual, and CPM is credit procedure manual. So if these things have been in line with that, facility is in order. Is the facility within single borrower, related party, and industry product specific limits? Now I will go and explain what is this in details in my next slide, because you need to understand who is a single borrower, who is a related party, and the type of industries and products we set limits. So for the moment, I'll give that, but we also see before we give approval of the credit, we see this particular, is credit rating carried out and facility fall within the investment grade. Now, when you get this appraisal form, generally they will also have done the rating of this customer. And if this rating is, you get a C, that means below investment grade, credit risk will at once will say, okay, this subprime client, he doesn't have the repayment capacity, please decline. So response and approval is based on the rating. Does the capital charge on proposed facilities accepted? Now, to explain this, I also took I think I already explained to you on the board earlier this particular aspect, which is similar to like this. You have two companies, or shall I go to the board? I think that will give a better understanding of you. I'm going to go to the board and explain. We have company A, which is AAA company. We have company B. This company is not rated. Or we say single B company. Rating is B. We also will discuss something like that when we go into Basel Accord in computation of risk-weighted assets. And generally, if you have a AAA company, the risk weight they say is 20%. This is 100%. If these two companies want to borrow, I have moved back to my slide again, and I will go back to the board again. I will speak a little louder so you could hear, because I'm speaking to the laptop microphone. And so these two companies, one is rated AAA, the other one is, I'll cut unrated instead of, we'll say single B. Their risk weight, as per Basel regulations, B will carry 100% risk weight and AAA company will have 20% risk weight. We say both companies want to borrow 10 million each. And this particular company wants to borrow this 10 million on clean basis. They are not offering any security. Whereas we'll say this company wants to borrow this 10 million, they offer 20 million worth property. And this particular company say we want to borrow at, we'll say 8%. And this doesn't specify. It will apply our sheet rate is 12% and they are happy with it. Now I want to ask from you, if you are in a position in the risk, which company would like to lend this money? And looking at this example, I'm going back to the presentation again. So we come back to our presentation again. In that we said, does the capital charge on the proposed facility is acceptable? Now, if you look on the board, I said a company which carries 20% risk weight is AAA company. That is, A has a AAA classification of credit rating, will carry only 20% of risk weight. So you take 20% of 10 million is 2 million is their risk weight. Whereas company B was credit rated as single B, and single B company carries 100% risk weight. So 100% of 10 million is 10 million itself. So if you need to have capital adequacy of 10%, 10% was 10 million was the risk weightage of B, and 10% of 10 million is 1 million, whereas 20% is the risk weight of 10 million of the other company, which is A, and 20% is then 2 million. 2 million, 10% of 2 million is just 200,000. So if you need to fund these two companies, company A need only a risk capital of 200,000 compared to company B, you need to provide 1 million. So this is what you call capital charge computation. I will explain this once more in detail when we go for Basel Accord explanations. But in your risk response by the credit risk department, they also compute this and see how much capital you need to allocate for this particular type of facility. Thus, all counterparty risk of qualitative and quantitative aspects being adequately analyzed. So we know that in your evaluation is either you need to do two types of evaluation. You need to do qualitative analysis and you need quantitative analysis. Quantitative analysis actually financial analysis. Qualitative analysis is all other factors like their market share, the environment they operate, management and ownership, all that is been qualitative aspects of the company. So generally business units does this, but risk department before they give response or approval, they also looked into see in that appraisal form these things have been done properly. Thus the pricing reflects riskiness of the educate. Now this appraisal form will carry the interest rate, the amount which they're going to charge. So risk department, if they think the interest rate what you have applied to this client is not in line with the risk what you identify in this customer, and if the customer is more risky, you may recommend a higher interest rate than what they have already proposed. As the structure is based on customer cash flows and in form of appropriate product and channel. Now, you also looked at how the facility has been structured. You remember we went on to looked at trade finance, how those facilities, those are some are short term, based on the duration they need to do the letter of credit and then manufacture and then shipping, all that taken into consideration, and the time allowed to the importer to sell is the time duration actually need to settle those facilities. And as a result, we arrange facilities such as revolving import loans, a letter of credit line, and on the exporters we arrange foreign bills purchase and packing credit bill. Those are actually matching the customer needs with the right kind of product and channel. So we at the risk department we looked into that, how we have structured the facility. Appropriateness of covenants and collaterals to mitigate risk. Now, if the risk is higher, we need to mitigate. I told you when we were doing the credit evaluation on the business unit where the counterparty risk is done, we mentioned risk can be mitigated through covenants, collateral, and price. So in this appraisal form, we looked at whether adequate collaterals or covenants are placed in the offer letter to make sure that customers' risks are mitigated. If answers to most of the questions are yes, what does risk department does on that appraisal form is to give their approval. So this is how risk department participate in the credit approval process. So they have identified risk, they have measured it, now they have done the response. I also, while doing this response, I said single borrow limit. Now, single borrow limit is a regulatory requirement, which is actually central bank has given this requirement. Now, what does the central bank wants in this is they want to see whether the bank will not put all eggs in one basket. They will not lend most of their money to large single customer. So single borrowers are the large borrowers, and we want to see how they, if they are given a very high value of total advances by the bank, central bank has a limitation on that. So the limitation goes as maximum amount of accommodation, and how they do that is they have set a direction on the bank. The direction reads like this: facilities to a single borrower or a group of borrowers, net of collateral cover in cash. That means if I want to borrow 5 million rupees, if I give you a cash, gold, or government securities, that doesn't count into my borrowing. So you need to net off that, because that can be, bank can anytime recover by offsetting those facilities. So the net of collateral cover in cash. Other collaterals are not counted. Cash, gold, government, or CBS securities or guarantees given by the bank can be taken into consideration in computing the net amount what the customer has borrowed. So the net amount should not exceed 30% of the bank's capital. Now say if a bank has a 10 billion capital, they can give a single customer is maximum of 3 billion rupees. And if it is a group of customer, they can give is 33%, which is 3.3 billion only. So based on the bank's capital, central bank has restricted the amount of borrowing by a single customer. This is what you call single borrow limit. Now, however, central bank also knows certain customers, this will be a hindrance to borrow money. So they have given some exemptions. Those exemptions have gone to government of Sri Lanka, various institutions, especially Ceylon Petroleum Corporation, because their imports are of very high value. If those oil bills are very much higher than the bank's capital, which finance those oil bills. So if we have to apply these single borrow limits, CPC will not be able to in business. So they have exempted Ceylon Petroleum Corporation. Similarly, Ceylon Electricity Board are also being exempted because their volumes of borrowings are also very high, because they need to bring in various equipment of very high value at certain times to install electricity for various places. So these, they have been exempted. Now we move on to the other restriction is a related party. Now you need to understand who is a related party to. They also say the related party, the direction says financial accommodation, that means loans and advances to related parties, creating liabilities or services to the bank by subsidiary, associate, director, key management personnel, or relations of director or senior management, and shareholder owing material interest. So I will tell you there are certain restrictions when you are lending money to related parties. Related parties are, most of the banks have their subsidiaries. Now say banks will have a leasing arm, and it will go as different name. For example, now Sampath Bank has another finance arm called Siata Finance. It's a subsidiary of the company, and so that subsidiary is a related party of the Sampath Bank. Similarly, directors of the bank are also related party. Key management personnel, we call them KMP, are the corporate management of a bank. CEO, deputy general managers, or assistant general managers who consist of the corporate management, a decision-making body, are called key management personnel. Then also they say relations of directors. That means wife of a director or a wife of a senior manager, also a related party, because then they can use their name and borrow. Therefore, there are restrictions on them. I'll tell you what are those restrictions and what kind of security these related parties need to provide if they want to borrow money from the bank. Then the equity capital, which earlier under the Basel II stood at 10% of total risk-weighted assets. Now from 2020, I think Central Bank of Sri Lanka, after the closing of 2019, they have increased this to 14%. So ownership of issued capital carrying voting rights of by a company or incorporated body or an individual have a upper limit of 10%. Now there's another restriction by the central bank. They say a company owning shares of a bank or a single person owning of a share of a bank can have maximum of their holding to the 10% of the total equity. Now, however, this can be enhanced up to 15% in the case of that shares are issued to restore the capital adequacy. If banks need to borrow money from their investors, banks need to enhance their capital and issue right issues, they can get central bank approval to go up this 10% into 15%. Or else, individual can have only a 10% or individual company have a 10% limit. This can change based on right issues or a foreign investor coming and taking a shareholding of a bank. Initially, central bank will allow upper limit at 10% to be bring it back to 10% at a given period of time. So these are some of the regulations which I will explain in our compliances more details, but where credit is concerned, these are the three areas. Now this slide is called lending to directors and their interest. So I explained to you what is a related parties. A subsidiary or associate company of a bank is generally a related party. Most of the banks have their headquarters or head offices in some kind of a tower, and that tower is owned by another company. That particular company is 100% subsidiary of the bank, and banks pay rent to this particular company. These things have been done to minimize the tax liability. So these things are possible. So borrowing by these subsidiary companies will come under the subject of related party. Any of the directors or key management, I explained. Close relations of the key management and directors also I explained. Shareholder owning a material interest, I also mentioned about 10%. Material interest here is 10%. Now say if bank's total share is say 10 billion, a single company or a single owner of shares cannot more than 1 billion shares. That's what the regulation says. We also have a situation, the number 5 in this slide, say a concern in which any of the bank's directors or close relations of any other bank's directors or any of its material shareholders has a substantial interest. Now, this needs a little bit of explanation. Simply because most of our companies are going as groups or conglomerates. Now, these group of companies also have banking shares, and they also put directors into banks based on the number of shares they own in a bank. So if a bank has a director, we'll say he comes from a company A, and this company A has 10% shareholding in the bank, and as a result they put their CEO or the managing director of that company A into the bank's board of directors. So now he has become director of the bank, and as a result the company A has become a related party. And if company A is a group of company, then there is this problem will start. This company A may have B, C, D, another 3 companies in their group, and company A may own 100% of B. As a result, the company B, which is a subsidiary of A, also become a related party of that particular bank. Of that, if company C has 50% shares of 50% ownership of A, that also exceed the material interest figure of 10%. Therefore, company B also become a related party of the bank. If we have another company called D, which is also managed by company A, but they have only 8% shares, then of that D is not a related party because the material interest of 10% is not there. So if any of these A wants to borrow money from the bank, they are considered as a related party. B, which is 100% owned by A, wants to borrow money from the bank, also considered a related party. C, 50% of C is owned by A, therefore above material interest, C also become a related party. D has only 8% of A, and A is a related party, but it doesn't have a material interest of D. D, if decide to borrow money from the bank, D will not be considered as a related party. So related party has various restrictions. That's what I showed you. So these restrictions are given by the central bank. If they want to borrow money against deposits, related parties can be given only 90% of the cash value. If they want to borrow against insurance policies, they can get only 75% of the surrender value. If they want to borrow against property, they can have 60%. Now you see an ordinary customer who wants to borrow money, generally banks may provide up to about 75% of the for sale value. Whereas if you looked at a related party, that restrictions come here. They can borrow only up to 60%. Similarly, you can look at other securities like company shares, they can borrow only up to 50%. Stocks in trade, once again 30%. Any goods under pledge, if the goods are under dual control of the bank and the customer, and if it is non-perishable, they can borrow up to 40%. So there are certain restrictions on the related party to do transactions with the bank, and credit risk management will have to look into that. If a director apply for a loan or a shareholder who is having material interest apply for a loan, to see whether these guidelines have been followed. Now I'll move on to area we call it portfolio management. Now we are going directly into credit concentration risk. Originally, I told you that we looked at customers. We divide credit risk in two areas. Up until now, we looked at default by a customer. And going into that customer, we also looked at our related party customers. We looked at our single borrower customers. We, in credit evaluation side, business unit, they do the financial analysis, they do the qualitative analysis. When they brought into risk management for their approval, they looked into credit rating. They looked into whether the guidelines of the banks have been adhered to. It is against the it is in line with the policy. Then we'll also looked at how much capital we'll have to set aside to give these facilities. Once all these things are done, we come to another very important area called portfolio management. We looked at single borrower as a large customer. Now we divide our total lending to all customers and we categorize them into different industry sectors. Central Bank has guided the banks to follow this particular pie chart, and in that they have identified 11 industry sectors. The first one, because we are an agriculture-based country and we want to be sufficient in our food production, Central Bank encouraged the banks to lend to this particular sector. And the first sector is called agriculture and fisheries. And that sector, there is a limitation. Minimum of 10% of the total lending by the bank should be given to this particular sector. And every month when bank provide the statistics, they have to justify the central bank that bank has followed the instruction and given more than 10% of their facilities to this particular sector. They also identify another sector called manufacturing, tourism, transport, construction, traders, new economies, .com companies or software companies who are in the new era of technology, then financial and business services, infrastructure, road building and other things, and other services. Other services include your retail credit like credit card, owning and personal loans and etc. So if you have 100 billion total lending portfolio, you divide the amount of money what you grant to each of these categories. And generally, portfolio management is based, your economist and the risk management will have to foresee which industries are more lucrative, which are going to get more returns, or some industries may fall into high risk categories, and limitations should be placed on this. Our portfolio management is generally banks prepare a budget. Now that budget discussion, especially if they are decided what type of sectors they are going to undertake, risk management will have to participate in the preparation of sector-wise exposures based on their studies and forecasts. So these are the categories. I'll show you how a budget has been done.
Sir, I have a small doubt.
Yeah.
Why central bank classified construction and rice milling sectors as high risk segment?
Rice milling sectors.
Rice milling and construction sectors are high risk list.
Where construction sector is, it's into real estate generally. Real estate business, we believe in our culture. We think always the real estate prices will go up. But world has not acted that way. If you know what is world financial crisis, mainly the real estate market crashed, and the banks which took real estate as collateral, they couldn't match the collateral value to the loan value. When the loan get defaulted, they couldn't realize the total amount what they have granted. For instance, now I'll explain to you. Especially in Sri Lanka, we haven't gone into a situation like that yet. But there's a quite possibility now. We were talking about sometime in risk management, a bubble will burst. Construction bubble will burst. What we are referring is a lot of people thought the best way to make money is to build apartment complexes. So most of the constructions, they thought to have a small piece of land in urban areas, especially in Colombo, and go into high rises so they can build any number of apartments, and those had greater demand. There was a time there's a greater demand because of convenience. People who were traveling from outskirts of Colombo was preferred to be in Colombo mainly to avoid traffic and various other convenience they enjoy. So there was a very much demand for condominium type or the apartment complexes. Now see the situation. Uh, More than the demand, people started building, and now we have a surplus of apartments in the Colombo city. And especially when you have a situation of people were given the opportunity based on COVID-19 to work from home, apartment is not ideal place to uh, if you are working, in the morning you go to work and come back, you have a very nice place to stay. But generally, Sri Lankan would like to have a garden space and all that. So now the demand for um, apartment type of houses is getting slowly reduced. As a result, the price of these condominiums have come down. If the bank has concentrated on this particular construction aspect of it, funding condominium properties, now they are facing a situation because those things are not selling and those customers are not in a position to pay. And when the demand loses, the price also will come down. And even if banks take over such properties, they may not be able to recover the full value of the loan. As a result, I think construction industry is classified as a high risk. We were talking about rice milling also. Rice milling, yeah,
Yes.
rice milling is another aspect because that is to play with the technology. Now, we have few big time players who could buy major stocks, entire stocks in the country because they have the capacity to mill and produce rice, and they have the capability and the capacity to buy all that. Whereas small rice millers, their technology is not sophisticated as those those who having. They say they have a monopoly of technology on those and the capacity to do it. So the small timers may find it difficult to compete and arrive at the same costing like the big player. And as a result, when the government imposes control prices, those small players may find it difficult to do their business, and as a result, the borrowings what they have taken from banks will not be paid. and as a result, there will be defaults. So when you say rice mills, it is not the overall rice mills, especially the small-time rice millers are in little bit of difficulty because they don't have capacity to stock. They don't have the latest technology to get the cost advantage. They may not have the fleet of vehicles, but they require to transport this rice into various places in order to sell. As a result, those customers will find it difficult, especially under regime of control price. So I think the government also wants to give rice at a control price because otherwise the traders will have their say in deciding the price, and those are not politically will help the government. So government need to bring in especially the staple food under control price. So as a result, small time millers also will find it difficult to maintain their business and to pay back the loans what they borrowed. So that is, I hope you understood the riskiness of these two. Um, Now I think apart from that, we have a difficult situation in two other sectors like transport and tourism. Um,
Yes.
Tourism, you know what has happened here because we don't have foreign visitors, and as a result, all of our facilities, hotels are now only catering for locals, and by catering for local under those discounted rates, they may not be able to earn the forecasted profit. And if they borrowed money from banks, um, they may also default. Tourism, the riskiness in this particular sector is not only the hotels, the large hotels, there's a lot of other associate industries linked to this. You have tourist drivers, you have guides, you have people who supply food stuff to these tourist hotels. So it's a large network actually supports the tourism industry, and all will find it difficult to pay back the facilities what they have taken from banks. So what the government does on these sectors, if there is a short-term difficulty in the industry, most of the countries they provide a moratorium on loans. Moratorium means they give time to pay back. But as a result, banks will find it difficult. Their cash flows will get stopped. Loans have been extended for periods which they would have got their cash flows. As a result, financial sector may go into weaknesses. Now, we also have, if you look at this slide, we have put banks also fund finance companies and leasing companies. Those are number 8, financial and business services. Most of the banks in this category, they don't have NPA at the moment because you bank, other financial companies, if they borrow money, they will make sure that they will pay us. But if leasing companies which have a moratorium on their customers imposed by the government not to charge their lease rentals on a regular basis, they are also finding difficult to get their cash flows. When they find difficulty in getting their cash flows, there is a possibility these companies also will get into a crisis. And I don't know, in another country, if a financial company failed to make their obligations, right, the other party, the lending party or the customer, have the right to go and file a petition and get those financial companies license cancelled. So Sri Lanka, we have been little bit lenient on this. Otherwise, we may not have situation like ETI, the finance. Those companies should have been sealed off long time ago because of riskiness in this particular sector. They might give a bad example for others also, and people will be reluctant to place their money in this finance company. So Under these circumstances, under the COVID-19, we have not only one area, we will not have construction, we have areas like tourism, transport, construction, financial and business services also in bit of a trouble situation at the moment. New economy might, do well. Now I'm doing a online training to you. Earlier we would have been in the classroom. So this was possible due to this kind of programs what we have to conduct online training. So those companies who provide such facilities, and especially people who provide the telecom lines, they make a lot of money. Now probably you need data throughout this period of my presentation. You need to have your internet on. You will be charged by your internet provider for that. And those companies might do well under the kind of a situation like now. So central bank divide these 11 sectors, and they want banks to report overall lending to this particular sector. Now I look at this particular site from a bank and looked at their overall 143 billion lending in at a given time, and based on their risk evaluation or the given by the bank's risk department, next year what they want to do is they want to increase their lending to 152 billion. So this is we call budget forecast, and then risk management will join their finance department on this situation, and also they will inform the guidelines given by central bank. Now here you can see 9.5 billion gone to 15.7 billion in the agriculture and fishing sector, because probably under the current circumstances the 10% threshold given for banks might get increased. So banks need to forecast in future what does the government wants to do in future. So they have increased the agriculture line very much higher. Certain manufacturing also should go up, but when this was done, they would have thought imported manufacturing goods are sometimes cheaper than locally produced. So that's why we have influx of so many things coming from China here at a very much lower price than what we could produce here. So this particular bank would have identified if that scenario remains, they may need manufacturing, they might stop certain things and they will get into trouble. So they have reduced the. Now this may have done when the tourism was booming. So from 2.7 billion, they have gone to 6 billion. Similarly, transport they found a little lower because most of them may have shifted to leasing companies and so on. As a result, you will have construction at this particular time. They expected a further boom, so they have increased their values. New economy they have increased. They have increased the traders. Financial sector they have increased because there is more opportunity for people to borrow not only from banks but from other financial institutions. So bank found another new business by funding them. So they have increased this infrastructure. Generally, these things are done on a very long-term loans. So this particular bank doesn't want to go into that kind of lending. Other services they want to increase. Credit card business they want to increase. They want to increase the pawning. They want to remain the pawning at the same level. So this is how the sector is being managed. So risk management get involved in this sector, and on the right side, the forecast is the limit set by the bank for next year. So any facilities being proposed for tourism which exceed total proposed limit of 6 billion, there is a chance that risk management may object saying that our exposure is high. to this particular sector. So they might write a remark saying, we may have reached the highest level of approved limits, approved sector limits on this particular sector. Based on that, you can even decline a facility. So this is how what the central bank wants us to maintain the portfolio and manage the portfolio. Now I'm going into little bit of other products or the overall analysis of the loan portfolio of a bank, loans and advances. So I have taken these slides from a bank. This is done in 2013, so it's a long time ago. They had overall loan portfolio of, in 2013, the first quarter, 31st, they had an overall portfolio of 131 billion, out of which 78 billion loans and advances are paid on right on time. That means they don't have a single day overdue. Now, banks don't need to classify them as non-performing up until 90 days. These facilities are overdue. That's the threshold or the duration given by the central bank. Loan which is not been repaid for 3 months, and if it goes beyond, only it will become non-performing loan. Similarly, overdraft which has not operated for 3 months or which has been excess above the limit for 3 months are also considered the non-performing loan. Anything below that 90 days or the 3 months installment due, we call it overdues. They are not actually the ideal loan portfolio to have, because the overdues might, if they fall in another 1 month areas, they might go into the NPA. So this is also a risk area. So on this particular bank, the first line, the first quarter, they had 131 billion worth of loans. Only 78 billion is second quarter we moved in. They have increased their portfolio by 5 billion, but they have increased their performing loans from 78 billion to 87. That means 9 billion has fallen into this. So they may have recovered part of the overdues and part of the NPAs. So second quarter they have done a little bit better. Third quarter they have 1 billion extra. All that 1 billion extra is still in the performance section. So overdues and NPAs remain same. So they have not done much recovery on the third quarter. Fourth quarter, they have a 5 billion again increase, but their performing loans have gone to 97. That means 9 billion has gone. They have reduced their overdues to 29 from 32. They have reduced their NPA from 17 to 16. This shifting from NPA to overdues to performing loan sector is the analysis of riskiness of the portfolio. Higher the NPA, higher the risk of bank's loan portfolio. We call it asset quality has declined. Now under Corona, this need to analyze very carefully, because certain loans are given moratorium. Those should be kept in the performing sector because their due date has been shifted. However, those who have not been allowed those moratorium or the extended settlement period, they will quickly go to overdue and also to NPA. And when the NPA goes up, bank's asset quality will deteriorate, and as a result, bank will face a higher risk. Now, what I will do now, again, we'll go to another analysis which I have done in this. I have done analysis of a bank. Now, I actually took these figures from Commercial Bank of Ceylon in their last annual report. So it's a public material. Anybody can access it. So I took the actual figures in billions. They made a profit of 17 billion, which is quite a large amount of profits. Their return on assets, you remember each asset employed how much money, each rupee they employ, they make 1 cent and 1.27% on return, the net profit. Return on equity is 13.54. That means this particular company is looking after their shareholders, giving them more than fixed deposit rate for their investments. Non-performing loans. Now this is where I came, because I switched from that slides here to give you an idea of the bank's non-performing ratio. That means gross. That means when you take an overall portfolio, like the total advances, their non-performing is 4.95, which is, under the current context, it's okay because of these moratoriums and economy is not doing well. But however, banks would like to keep this particular ratio around about maximum of 3%. Their net is 3%. Net is actually you deduct from your gross the provisions you have made for these loans and the interest in suspend. That means if overdrafts have been, interest have been suspended, but it has been added to the overall overdraft. Once you deduct all that, you will get the net NPA. Net NPA divided by total loans, if you can keep at 3%, which is good. Actually, generally, most of the banks would like to have the gross profit, gross NPA at 3% and net NPA around 2%. We also will do this another analysis called provision cover, open credit cover. These are when we do the analysis. So I just went to non-performing ratio based on my slide here. Now from this, you may need you need to calculate the non-performing ratio of these quarters. The first quarter is 18 divided by 131 will give you the non-performing ratio of this particular bank. So if you have to calculate with me, what is the first one? 18 divided by 131 into 100, which is 13.74, which is very high. Which is a very high percentage in this particular time. So if you take the last quarter, it is 16 divided by 142 to 100. It's also 11%, which is also very high. So the riskiness of the bank's credit portfolio is one of the measures what we apply here is the non-performing ratio. So we'll move on to some other analysis. We also can take a product of a bank. I took here a product of a bank, an overdraft. So we'll say bank has a 40 billion overdrafts, and in that you will know overdraft has a limit, and most of our customers are supposed to maintain their balances below the limit given to them. So I took the first category as customers within approved limits. So out of 40 billion, 29 billion of customers are operating the limits given to them. So they are kind of a risk-free customers. Bank has evaluated their proposal, has done a proper evaluation and given them a high limit for them to operate. So if they operate within that limit, the chances of them defaulting is low. But in overdraft product, most of the customers doesn't stay here. They get a limit approved, but they send checks beyond that limit. And based on the relationship and considering the overall securities what you have or the business strength of the customer, bank used to exceed that limit. And here I have put another 8 billion has gone to that excesses. We also sometimes without approval of a limit, we also have thing called casual overdrafts. Customers issue checks, but the relationship is good. We know that they will settle in time, and banks, branch managers, sometimes they also have a delegated authority. They use that delegated authority to provide excesses. Those excesses, now in this particular situation, I put as 3. So total excesses are the 3 and 8 put together, which is 11. And more dangerous is the 3. So when you do analysis, you can do this analysis quarter by quarter and see the riskiness of this particular product. And if you are in the risk management, you need to inform in your reporting whether the riskiness has been reduced or riskiness has increased, or what kind of measures you need to give to the business line staff who are actually approving overdrafts to avoid the risk involved in this particular product. Then we can also go into pawning portfolio. Now here I have put some figures. Pawning 10 billion. Then overdue here is, you know, that I told you the pawning is a product where come under the Pawning Act. And the Pawning Act is like this. A customer comes and get an advance. That advance is due for payment only after 1 year, during the course of the 1 year. If it exceeds 1 year, it will fall into overdue. And banks, when it exceeds, bank will send a notice of auction. And that auction will take place probably after 14 days of that notice. Probably overdue pawning advances will remain almost 1 month before it can be auctioned. If at the auction, if a bank fails to get the loan value plus the interest, they might not sell. And at that point, that facility, they need to classify under non-performing because the customer has failed. Bank also has failed to realize this value. Therefore, it has a bad debt component here. And so they need to classify that. And in this portfolio of 13 billion overall, 10 billion has not reached 1 year, but they are performing. Anything which reached 1 year but has not been auctioned is 2. Anything has passed the auction is 1. So this overdue and non-performing created huge danger or the riskiness to the bank. So similarly, you can quarterly basis, you can analyze this kind of portfolio and look at the riskiness of that. The lower the overdue, lower the non-performing, is the lesser the risk for the bank. So we need to take some action to get these overdues quickly out, auction process faster, and make that even when you auction it, that you will get the real value. So sometimes risk department will identify this and they will suggest to the business units that reduce the loan to value ratio. That means if a Sovereign now fetch 70,000, they are giving advance of 65,000. We might, risk department say, don't go up to 65, give 60,000 or 70,000 worth. So then it will compel the customer to redeem their pawned articles. So that's how we looked at this particular portfolio. But in banks, we need to go a little further. Now, this pawning is, we have a underlying security by way of gold. Gold is central bank considers in their risk weight computation as zero risk. So pawning is you don't need to provide capital. Therefore, banks are sometimes, in financial terms, we say greedy. We are greedy of enhancing this particular product because you don't need capital to do this business. Plus, we expect we have underlying security to cover our facility. But there's another great danger in this particular product, which most of the banks experienced in 2013, which is the world market price of this particular commodity. Now, currently, gold is trading at about $1,600 per ounce. If you look at last 5 years, there are times that gold has traded at 960. So generally, risk managers believe something like this. They say history will repeat. So there are ups and downs in different prices of different commodities. Similarly, gold has done that downward cycle also in 2013, bringing ounce price to something like $960 per ounce. When the world market prices drop, locally also prices will drop. And if you have lent at a higher rate, those customers might decide not to repay their loans, and as a result, it can go into overdue and non-performing, and that will create more riskiness to the bank. So this particular product also need time-to-time analysis, and you need to produce reports to the Board Integrated Risk Management Committee to make decisions on limits what you should apply to this portfolio, or the loan to value ratio we apply to in giving facilities. So I will move on to another portfolio called leasing. This was also a security-backed lending, because either you keep a vehicle or machinery against the advance you give. So these are highly collateralized lending products. A lot of financial institutions would like to get into this business because they have security. As a security, customers will come and pay. But however, now situation, COVID-19, what has happened? Leasing companies has the objective of repossession of the vehicle or the machinery if the money is not being paid. Now, certain recent incidents or situation has caused direction from the government or give moratorium or give extended period of repayment for these kind of facilities. Actually, those moratoriums should apply to affected industries, but when you say leasing, it's very difficult to categorize saying to what type of industry this particular vehicle or machinery is being used. Now, even the companies which are very much in business has now tend to use those moratoriums, and as a result, banks will have riskiness in their liquidity because cash flows are not coming. You can check the non-performing those facilities based on the type of collateral they have taken. I have taken vehicles and machinery. Vehicles, when you lend 7.3 billion, 518 has gone to non-performing. Machinery, 878 against 69. So you can do this on a quarterly basis and see the riskiness of this portfolio also. I think we have now checked overdue portfolio. So we looked at the overall portfolio and see how credit quality, and we looked at overdrafts portfolio, product portfolio, and see the customers who stay in limit and other things. Then we looked at owning, we looked at leasing. I think we'll take a break from portfolio management. When we come back, we'll continue this because these analyses are done to check the concentration. That means concentration is where you have put your eggs. If a company does in the financial sector only leasing, and now they will find it very difficult because money what they lend is not coming back to undertake new business. So therefore it's better in a bank which has a large portfolio of products to check which areas get affected when there's a crisis. So we'll take a break from now from analysis of portfolios, and what we do is we will go into a new slide called stress testing of credit risk. This now there is a new guidelines have come. Therefore, I am going to take one whole session for stress testing, because here I have only mentioned about the credit risk. Central bank insists the banks to do stress testing to cover all types of risks they undertake, including market risk, liquidity risk, etc., and even operation risk on times of stressful times of economic depression and economic crisis are looming along with the COVID-19. So when you come back after this, I will only touch here in nutshell what is a stress test, but we'll go into details in a complete program. Thank you. We'll come back and continue at 4 o'clock. Okay, I'm back again. We are doing stress testing on credit risk now. It's another area to analyze your concentration levels. Stress testing is stressed. The word stress means under difficult circumstances or not normal. Stressful means depressed, or when say economy is under stress means economy is not performing well. When a human is under stress means he's either been loaded with a lot of work and his thought process cannot be put into action in the normal process. So stress testing means you are testing if a situation or the scenario moves of your credit risk into difficult times. Now, at the moment, in fact, we are in difficult times. Stress testing is required generally before we reach a situation of this nature. However, now since we have experienced COVID-19, it's opportune time to see the result of or the consequence of this particular epidemic would have affected credit risk in banks. So it is in definition, it's a process. So you need to follow a set of rules in doing a stress testing. So process of assessing performance under adverse or unusual conditions and the impact on profitability, capital adequacy and liquidity. So generally what happens when you get into higher level of credit risk, your NPA ratios will rise. When the NPA ratios rise, your profits level will go down because those loans which have gone into areas will not be recovered with capital plus interest. Sometimes you may have to write off, or you may have to reschedule, you may have to give concession on interest. All those will affect the profitability. When profitability get affected, it also affect the profits, annual profits what the bank earns, partly will be given as shareholders dividends. We also reserve certain amount of profits into reserves. Those reserves will add up to the equity, and the capital adequacy will improve. So improve capital adequacy, there are two things. Either you must bring in capital or you must increase your profitability. So when profitability get affected due to credit risk, your capital adequacy will get affected. And profitability get affected means your cash flow will affected, because amount of money what you lend will not come on the time you expected. When that happens, bank will have a liquidity problem. So stress test will result in impact on profitability, capital adequacy and liquidity. Now credit risk, I take few scenarios. Increase in NPA and provisioning. We'll take a scenario. We have in the bank a portfolio. In that portfolio, we have three sectors. We'll say transport, tourism, and construction. Now, these three sectors, government sometimes will step in and say, okay, give 3 months moratorium. Loans which were due for the month of March, April, May should be not collected, then they put at the end of the period. Or they might say, give 6 months moratorium, that means March, April, May, June, July, August installments will not be collected. But instead of that, you extend the period to recover those 3 installments at the end. And while this moratorium is on, still you have a chance that you don't have to categorize this facility into non-performing. But our stress testing will go a little further. You imagine, say in these sectors, if you expose us, I will say 10 billion each. So we'll say you have a 30 billion portfolio and you have extended by 6 months, and you expect the economy to perform well after the third sixth month, and for them to pay as usual. But how many of this 30 billion will come into performing section after the 6 months? Tourists may not come after 6 months. There is no demand will create for real estate after 6 months. So you create a scenario based on some economic facts or Vestal analysis or whatever, and with your team and statement from economist, you say even despite having a moratorium of 6 months for repayment, 25% of what you have allocated for tourism will not commence repayment at the end of this moratorium. That 25% amounts to a certain amount, and that certain amount, the income will not be received by the bank. So we'll say you have a 10 billion facilities for tourism, which you have postponed for 6 months, and out of which 25% is 2.5 billion, will go to NPA because even after 6 months, they are not in a position to pay. And when that happens, a large chunk, 2.5 billion, will fall into NPA. When that happens, your interest earning out of that 2.5 billion will cease. As a result, your interest income will get reduced. When that interest income gets reduced, your profitability or the NPA will affect. And when the NPA affect, your chances of getting capital adequacy, that means we generally calculate the first, we'll say up to August, you have a profit certain. After August, your profits will decline or you will make a loss on those loans, and those will have to be written off from the annual profit of that particular year. When that happens, your profitability get affected, your capital adequacy also will get affected. And you may even go a little further and calculate the cash flow out of this 2.5 billion amount due month by month, and you will see the liquidity shortfall. Unless those liquidities match with new deposits, you may need to borrow money from central bank or your other long-term or short-term funding arms. Then you will be paying interest to them. That will adapt. That will also affect your profitability. So you take a scenario. We'll say we have a tourism portfolio of 10 billion, and out of which 2.5 billion will fall overdue even after the moratorium period allowed by the government. And moment that happens, because the previous 6 months also not been paid, they have passed the 90-day rule, and you may have to categorize them under NPA. Then once its NPA is done, you may need provisioning. You may stop accrual of interest. As a result, you will have a loss situation. So computation of that is called stress testing. And this can only happen to one portfolio, or you can have negative shift of NPA category and increase in provisioning. If you think already you are having NPA of say 5% of tourism or 5% of construction, this duration will change, increasing the provision figure. I will explain to you what it is. Generally, if a loan which is going for the first time into non-performing, we put them into category classification called special mention. Only you need to stop accrual of interest, those will go into suspense account. But you don't need to do any provisioning. Once it passes 6 months, you need to provide from 3 to 6 months, you need to provide 20%. 6 to 1 year, you need to provide 50%. Then 1 year to 18, you may need to provide 6 to 12 months, you need 20%. 12 to 18 months, 50%. Beyond 18 months, you may have to provide 100%. So these category changes of NPA shifts also will add up to a further debit to your profitability, and then your profitability will decline. You also can look at the forced sale value of mortgage collateral. Customers generally, as long as their collateral is higher value than the amount what they have borrowed, they keep with the intention of somehow, repayment or asking reschedulements, or bank also will have hope that we could recover our money. But if the forced sale value of mortgage collateral falls below the price outstanding of the loan, then bank will need to have expecting losses. So we may need to calculate this on the, we'll say, on the construction industry. You may have given 10 loans, keeping 75% of the forced sale value as collateral. Now prices fall by 35% because of the stress situation. Stress situation comes, either demand is not there, or there is large supply, but there's no demand for condominium property. As a result, price falls. If price falls below 75% of the for sale value of original loan, then your mortgage collateral doesn't have the same value of the loan outstanding, or even have a lesser than the loan outstanding. The moment it is lesser than the loan outstanding, bank may need to do something. Otherwise, what happens is customer will lose interest because he may not be able to get anything if already collateral is mortgaged to the bank, and bank try to realize it, they will get less. If the customer try to realize, he also will get less. So he will lose interest and he will stop payment. When that situation happens, this will go into NPA. And even if you manage to dispose the property, you will get a lesser value than the loan value. And that loss also has to be written off. And those will add up to your lower profitability. And that is computation of that is called stress testing. Now, this has not happened, but you need to foresee that it might happen based on certain points. So you need to actually give reasons why you are doing stress testing. You need to identify the scenarios which will involve for you to take that reason. Now, for instance, today there was an article that one of the methods the government is adapting to revive the economy is to reduce the interest rates. Now, when the interest rates are reduced, benefit goes to the borrower, because when the interest rates are reduced, immediately all the facilities of bank need to reduce interest. Most of the banks may not immediately reduce on their fixed rate loans, but customers will demand. They will say current market rate is this, therefore please reduce the interest. If even at reduced interest rate, if repayments are regular, bank will not have a loss situation, because the cost of funds for the bank at that time also will same. But just imagine, bank has funded all these loans by way of collecting fixed deposit at a very high rate. And those rates bank may not be able to reduce, because bank has come to a contractual agreement with those depositors that at maturity that they will pay, we'll say 12% or 10% interest. And money deposits taken at 12% being used to fund credit which are given at say 10%, what will happen? Again, bank will have a cutoff of their profitability figures. This is also another area, because reduction of interest also may bring in certain risk to the bank. This particular article, in fact, they were talking about banks will make a lot of money based on if they have invested in bonds and treasury bills which have been bought at high coupon rates or high rates of from central bank, which they can market at a higher price than the market rates and make money. Just imagine if they have taken deposits from customers on a low reduction in interest rates, then they have a problem. So we may need to look into various risks, not only credit risk, those are actually market rate risks coming on based on the economy, how it is performed. So we will have a complete session on stress testing with examples done, covering all sort of risks. At the moment, you may need to understand stress test for credit is done based on increase in NPA and increase in provision. When you do both them, you will lose interest. and you will have a hit on your P&L. When that happens, your profitability will get reduced. So that amount of loss of profitability has to be shown as a result of the stress test. So we may need to build up a scenario to arrive at that loss. These are the factors which will contribute to that particular loss, and this is the exactly you have to put that contributory factors into figures based on the loan outstanding what you have and the amount of percentage which will get subject to that scenario, and based on that how much interest you will lose, how much additional provisions you have to make, and once you do all those calculations, you will arrive at the hit on your profitability that has to be shown as a result of the stress test what you carried. So we will, don't worry, we will take all the stress testing pertinent to all types of risk in a one session, and we'll do computations on the screen, and we'll give you a better understanding of what is stress testing. So today's last slide on the concentration risk is to give report to your board of directors. Board of directors, you can't write essays of all your credit risks what we have discussed. They would like to see in a very simple format how risky our credit portfolio is. So we create certain indicators, we call them key credit risk indicators. If it is related to operations, we say key operational risk indicators, and give them a monthly chart with actual figures, and we'll do a comparison of the previous figures and see the bank as risk situation has increased or risk situation has decreased. And we also compare that with a benchmark. Now, for instance, one of the key risk indicators I told you was non-performing loan. I went to that commercial bank slide. The first slide shows gross NPL. That is non-performing loans divided by total advances of the commercial bank. Now, as at end of last December, stood at 4.95. This might get increased based on COVID-19. So one of the indicators you need to monitor is you may need either by monthly or by quarterly. Look at this ratio. This NPL ratio of 4.95, based on how economy performs and how your clientele performs their business or how risk they undergo, this might get increased. So predictions at the moment is banks will have a increase in the NPL ratio in coming months, simply because not only the affected industries but also other customers also might default based on certain difficulties they will have. Then we have another ratio called net NPL. You deduct from your total NPL your provisions you made and the interest in suspense you made, and divide by total advances, you get a net NPL ratio. Commercial bank, in my slides I showed you, they had 3%. 3%, or this might also will go up, and if not, bank may have to reduce that. Bank may have to provide for them as bad debts. When you provide means you will have a debit to your P&L account, and when you have a debit to your P&L account, you have a loss situation. So generally provisions, there is a guidelines given by the central bank when to make provisions, and amount of provisions you need, the percentage. So you need to abide by those. If not, you may subject to compliance risk. So we may need to do the provisions at the right time and the right quantity. So when that happens, your net NPL also will uh, will give the correct picture. Otherwise, net NPL will not stand good as a good key risk indicator. So we have non-performing loans as two major key risk indicators. We also can look at how bank has abide by the regulation and also um, done provisioning. Never mind, it may hit your P&L, but when you have a cover for future losses, when you make provisions, what happens is you debit P&L and you credit provision for bad and doubtful debts. When a loan goes bad, you can debit provision for bad and doubtful debts and credit that amount to that loss loan, and you can set off. Then you will have no bad debts written off again. So providing or making provisions for your bad debts will give you a cover where when situation really go bad with the loan, you can reverse your provisions and not to suffer further losses on your P&L. So this cover is also indicator of what precautions you have taken against your bad debts. So you take the total provision for bad debts divided by total NPL will give you a percentage called provision cover. Generally, a bank should have a benchmark. Generally, they say at least of your total NPL, 25% should have been provided. So when 25% of loans they go bad, you don't have to have a impact on your profit. What you do is you reverse your provisions and settle those loans. Then you may not have a situation. So this situation we call write-off, but you have taken out of the provisions which has already been provided. There's another key risk indicator in credit. We call it open credit cover. Now, open credit cover is a measure of it is similar to NPL instead of net NPL. NPL less provisions and IIS divided by equity. Now, here under the net NPL, what you touch was you divide the NPL minus provision and IIS by total advances to arrive at a percentage of your net NPL. Now, instead of dividing this NPL less provision and IIS, you divide by your bank's equity. Now, NPL less provision and IIS will give you a figure of your total advances after reversal of provisions and interest, the amount of bad loans in your bank. And board of directors would like to measure the riskiness of those by dividing it by equity. That means in case if we have to write off all these, whether we have at least shareholders' money to do so. So generally we don't have, but we would like to a certain percentage we should cover. So open credit cover gives that blanket cover whether how shareholders' money can be utilized in case of a real bankruptcy rather than touching the depositors' money. To those are statutory deposits. Central bank will, on a bankruptcy, will ask you to pay the depositors first. Shareholders will become last, and when the NPL position is there, even shareholders cannot be paid because those loans will not get repaid. And we would like to know if we allocate the equity, whether we can cover those loans. So these four key credit risk indicators need to be watched either monthly or quarterly basis, compared with the benchmark, compared quarter by quarter with the previous quarter's figures, and we may need to inform the board of directors, and with that they may be able to identify the quality of your credit portfolio. And quality of your credit portfolio reflects the credit risk of the bank. And Therefore, it's very important that we understand these particular 4 ratios, because your final task of your credit risk management, identifying, measuring, responding, monitoring, controlling, reporting. Reporting will be done based on these key risk indicators. And those reports need to get actionable. When you have quarter by quarter compare, if a bank's NPL is going up, what does bank does? They will strengthen the recovery action. Board of directors will say, you need to employ more people on the recovery, you need to repossess certain collateral and recover those loans, file litigation against the non-paying customers. All those actionable, recovery actionable things will come based on this particular ratio. So it's very important that we understand these 4 ratios as key credit risk indicators, and this is where through these key credit risk indicators we provide information to the board of directors of the bank. So with that, I think we have covered credit risk of the bank, which is highest amount in the balance sheet, and most of the banks, they consider one of the major risk area of is managing credit risk, and they put a lot of efforts in this particular area, because it will affect, as I said, when you do the stress testing, it will affect the liquidity and the investor confidence. When you have high NPL, people not want to invest in your bank. When you have losses associated with NPL, even your depositors who understand finances might be reluctant to place their deposits in the bank. So it's also will affect your reputation. And also, when you don't make profit, it will not give a proper return on equipment, return on equity, and as a result, investors may move out of the bank. So that's about credit risk, and it is a major risk, and we need to understand this proper, especially both parts. Credit risk will occur based on default. Default is by customers, so you need to understand the risk faced by customers, making them to default the bank. So we have gone through that in the evaluation. Then also bank can also do a mistake by putting all the eggs in one basket. That's where we touch concentration. Concentration can come from single borrow limits, can come from related party transactions, or you're assigning your entire effort on an area or a portfolio which will one day will go into bad. Now, banks which actually went after tourism 2 years ago, after the end of war, they thought tourism is the key, and it was the key actually, and because everyone thought that's the most growth area to do business, and a lot of people undertook various ventures related to tourism, borrowed money from the bank, and as a result, now banks is exposed to this particular sector. So once we thought it's a booming industry, now it has become a threat to the bank's stability, because there's a certain amount of credit risk, and the banks which thought it is the industry and went and concentrated mainly on that area got very high exposures on the tourism. Now they may be wondering how to get out of it. So concentration is the other risk. Bank need to diversify. Central bank give us certain guidelines, but banks may need to do in their budget allocations set limits. We call it portfolio limits, and those portfolio limits will be approved by the board of directors and should be practiced in their credit taking decisions. So that's how we end our credit risk part of it. Our next session is also another important area. We call it operational risk, and I'll give you a brief introduction before we close, because with the introduction of various delivery channels of our products, banking, originally we never had technology enable services. Originally we never had even machines. We did all manual, even the customers' ledger cards were handwritten. And thereafter, with the progress of technologies, we managed to get certain machines involved in getting the printed version of. Thereafter, we went to computers. Now, we have gone to kind of a virtual banking. So, operation risk has increased in all spheres due to we have undertaken banking operations 24/7 and 364 days a year. Originally, we enjoy bank holidays. Saturday, Sunday banks are closed. Opening timings are from 9 to 1:30. So operational risk lies only during the time when the bank is open for operations between 9 and 1:30 in the afternoon. And that time, if we can safeguard various aspects in the bank, we say operation risk is minimum. So what we did was, from external aspects, we had covered with security to avoid any bank robberies, but internally we had a lot of controls in the bank in order to safeguard frauds and various other misappropriations. So operational risk is the risk of loss resulting from inadequate or failed. Remember, these words are important because inadequate or failed internal processes. If the processes are run smoothly, nothing will happen. Operation will go smoothly. If processes in the bank are not sufficient, or existing ones will get failed, that will offer risk. Those risks are called operation risk. Then people are employees. If employees are either negligent or incompetent, they can make mistakes. Or if they are fraudulent, they can willfully steal data, they steal money. Then that situation also called operational risk. And banks also have various systems, especially computer systems, and failure of those or inadequacy of those also will result in operational risk. Apart from that, we also have situations affecting external events. Now, under current situation, the epidemic is an external event which led to banks to safeguard the bank's premises, safeguard their staff. So you have all these health issues are in place in order to entertain customers in your banks. So those, if something happens to those and you suffer loss, is called external events. External events can come from environment you operate. It can be earthquake, it can be tsunami, it can be flood, it can be even fire or theft. All these are external events, robbery, that may finally will result in a loss. And those So it is about processes, it is about people, it's about system. From if all those fail or get inadequate, you may subject to operational risk. And since of late, when we first with the when World Bank thought of risk management, they asked the Basel Committee to meet and identify how do you manage risk in a bank. So they first Basel 1 is only thought of credit as the major risk. When Basel 2 came, they were a little bit worried. It is not only the credit, it also operational and market risk also will get involved in making losses to the bank. So we will also go into how Basel Committee, this definition is given by the Basel Committee. They also talk about inadequate or failed internal processes, people and systems. External events are the causes of operational risk. So I'm going into next slide about universe of operational risk. Now we know operation risk is ultimate loss. The loss could come from legal liability or loss of damage or resources, or you may have to write down certain things, are all consequences of if your people not acted properly, your order, your systems failed, or some external event happens. So they have created a universe in sense to see Basel II committee in the consultation. First they say, how do we prepare a framework for operational risk? Then the committee in the brainstorming, they say, first we'll identify what will happen, what are the causes or the reason for operational loss. So they have identified these causes, inadequate or segregation of duties, which I am going to talk very elaborately on this. In banks, I'll give a small example. Generally, we prepare vouchers to pass certain transactions. Now, say if you want to transfer money from one account to the other, you write a debit to the account which you're going to charge and credit to the other account. Now we prepare a voucher. This debit and credit is the basic in banking. And those are generally double entry bookkeeping entries to keep our books balance. So you may have noticed in those slips, we put a person to prepare it. You write the name of the account on top, we give a narration, and then we give the amount, and there's a column for the person who prepared this particular transaction or the voucher. And there's another column for a supervisor's signature. Why do you need supervisor? Because you have been asked to transfer from one account to the other. If one person prepares and enter this into the computer, it will go. But why the supervisor to sign? A second person to sign. That is, we call it segregation of duties. Because one eye can't see the mistakes, so the person who prepare may not see the mistakes or any errors in preparation of those vouchers. You put another person who is much more experienced than the preparator to oversee whether the right exchange rate is being applied, whether the correct account number is being used, title of the account is right, and the amount you want to transfer is mentioned on this state particular voucher. Those checks and balances are done by the supervisor is kind of called segregation of duties. And most of the causes for errors in the bank is inadequate segregation of duties. This will lead also to frauds. If I can take money from one account and transfer to the other account, it's very easy unless if there's no supervisor there. Similarly, if your vault, if there's only one key to the key holder, he may take money when he wants. But if you have two key holders and another register to enter the vault, will give you segregate certain duties, and you may not be able to do errors or make mistakes due to negligence, or you can't do any frauds. So those inadequate segregation of duties are one of the major causes in banking or operational losses. Insufficient training. Most of the banks have their own training institutes, especially when you recruit a person, you would like to give him sufficient training to perform jobs or the task what he need to do in his desk. That will reduce errors and omissions and various other factors which will result in operational losses. So insufficient training also identified as a lack of management supervision. I just told you about why you need to supervise and sign this. Inadequate audit procedures. If your auditors are not checking your branches on a frequent or regular basis, what will happen is there could be frauds, there could be errors in the branches, and various other non-compliances will occur, finally will result in losses. Inadequate security measures. If your security measures like your CCTV, your security guards, your alarm to the nearest police stations, if those things are not in order, there are chance a robbery will take place and you will suffer operational loss. Poor systems design. If your computer system use a lot of breakdowns, and those will result also operational losses. Poor HR policies. HR policies will make the staff member very trained and competent, and also they will abide by certain rules how you operate. All the banks have this kind of rules called code of conduct, code of ethics. Those are, we call it HR policies. So those will not allow a staff member to misuse or do errors or do frauds, causing operational losses. So first, Basel Committee, when they are going for identification of Basel II operational risk framework, they started looking at the risk university, and in that first they looked at causes of operational losses. What are the reasons for operation losses to occur? Then they went to what events will take place. Now these, while causes are their reasons, they want to actually categorize certain types of operational losses, and they came up with, they call it events, which causes operational loss. In banks, we don't write say inadequate segregation of duties. With banks, they have identified these 7 events which will lead to operational losses. Internal fraud. Now here we looked at segregation of duties will cause internal frauds. If you have inadequate segregation of duties, one staff member can get into internal frauds. External frauds. If your security, inadequate security measures will come, external frauds will take place. Employment and practices of workplace safety. Now, employment practices, if you don't have good HR policies, you don't have good code of conduct, code of ethics, and certain norms where your staff members should behave. They can also create certain operational losses. Those will come under employment practices and workplace safety. Client products and business practices. Now you have clients. You need to, under the new law of customer charter, you need to provide them adequate information. Otherwise, they also can sue the bank on certain cases. Those, if you have to pay damage to a client, if you had a mishap in your banking lobby and if you claim certain money, those will go as operational losses. Damage to physical assets. If a cause occurs like poor system design, or as a poor system design, if you have electrical shortage and if your computer burn, those are events which will cause operational loss. Business disruption. If your systems goes blank and if you don't have a disaster recovery unit to pick up immediately, and those things will create losses and loss of reputation, those also will consider as operational losses. Execution, delivery and process management. Execution means even passing entries of a transaction. Delivery and process management. How do you manage your cash? How do you manage your treasury? How do you manage your various departments? If you make a mistake managing, those events will cause operational loss. So there are 7 events which we need to master this: external fraud, internal fraud, employment practices, clients' products, damage to physical assets, business disruption, and execution and delivery mishaps are the events which finally will result in operational losses. When these causes and combine together will lead to legal liability, we call it consequences. Regulatory compliances, because losses won't just occur, because it will lead to certain consequences, and those consequences, so regulatory compliances, loss of damage, restitution, loss of recourse, write-downs, reputation, business interruptions are the consequences of this. So Basel Committee looked into this before they recommend management of operation risk. So for the time being, I'm going to stop here today because operation risk is I'm taking as one complete session, and the next week when we meet, we go into rest of the slides. Rest of the slides will tell us how you manage operation risk. Similarly, same process of risk management will apply: identify, measure, respond, monitor, control, and report. So we will apply those 6 lines for operation risk also, and we'll see how we manage operation risk in bank. Thank you very much for today, and we'll meet you next Sunday.